least on large cap and the index itself, 17,974. Our market master of the day is with us. Sanjeev Prasad is Managing Director and Co-Head of Kotak Institutional Equities. Sanjeev, great to have you with us here on the program. Thank you very much for your time. I just want to start with earnings. I put out a piece last Friday looking at how FY24 earnings have been downgraded for the Nifty companies and the top 200 companies. And roundabout, in both cases, about 60% of the companies in both these groupings have seen downgrades. And some have been very, very sharp downgrades to that. You of course, look at earnings very intensively, you and your team. But I want to ask you, is this a temporary phenomenon, as many point out? Because Diwali was earlier, as compared to other years. So Q3 was different in that sense. Maybe a little bit of inflation hurting. Or is there a slightly bigger, more entrenched problem on the demand side? Your assessment.
I think, over the last 3 months, what we are seeing is a fairly big slowdown as far as discretionary spending is concerned. And probably there are 4 factors affecting the demand. Number one is simply, the ending of the revenge spending which happened after the economy opened, let's say, early part of last year. Number 2 is obviously lower confidence in the IT households now, given the fact that we have gone from a situation of, massive hiring to suddenly, a big slowdown in hiring. Number 3 is simply an affordability problem. Prices have gone up a lot in India in the last 3-4 years. And lastly, also have higher interest rates, which results in mortgage payments going up. So all these 4 factors put together is probably hurting, the ability of households to spend on discretionary items. Basic items anyway have been struggling for the last 3 years because lower income households got very badly affected by COVID in 2020 and 21 calendar years. And also high general inflation in 2022. So anyway, we have still not seen a full recovery of the income of lower income households from this, twin negatives, I would say. So all said and done, I'm not that surprised that you are seeing, some amount of earnings cut. I suppose these are more in the discretionary space. Having said that, these are reasonably well flagged. If you look at our own numbers, we haven't really changed anything in the last 6 months now. There have been some minor downgrades for some of the discretionary names, but otherwise earning numbers have been pretty much broadly the same in our case, at least for 23 and 24 for the last few months now.
Okay, that has been a common narrative, as you said, right? The slowdown that we've seen in consumption, especially discretionary consumption in the lower strata of the market, so rural, semi-urban, etc. But urban is a completely different picture. So in this K-shaped recovery, you're seeing a massive up move, especially in the premium end, whether it's real estate, auto. Is that a space that you think could gain more currency, especially in the listed entities?
Yeah, I won't agree entirely to the fact that only the lower income households are not doing that great. I think the problem now is pretty much quite broad-based. I would think. Even some of the people who were in a reasonably good position to spend, even probably they are starting to hold back a little bit. Because as I was saying earlier, the entire IT ecosystem is not looking that great. I mean, 6 months back, every IT techie had 3 offers and expectation 30% salary increase. That's clearly not happening. So there is clearly a slowdown as far as that entire ecosystem is concerned. And you have also seen a fair amount of job losses in the non-traditional IT services companies, right? So I would assume now the effect is slightly more broad-based than just looking at let's say the lower income households in urban and rural areas. Yeah, so let's see how things progress. Now coming to the real estate part, demand so far has been holding up reasonably well. But I suspect this is more to do with longer-term factors, nothing, in terms of a sudden increase in affordability of households. If you look at the last 5-7 years, real estate prices haven't gone anywhere, which means over the last 5-7 years, affordability has gone up significantly. Real estate prices effectively are down in real terms. So I assume that itself is, a big driver of volumes now. Plus the fact that over the last 6 months in particular, you have started to see finally real estate prices in some of the major markets starting to move up. So that may also be acting as the catalyst now for houses to start looking at real estate more favorably. So I suspect that is probably what is more driving, real estate demand. And availability had increased significantly last 5-7 years, and plus now there is some trigger of buying real estate because prices are starting to move up.
So again, slightly outlook. You said you've not changed your estimates, but I think you were more realistic to begin with in terms of estimates, as the team at Kotak always is. I just wanted to get a quick sense in terms of when do you think this will resolve itself? Will this patch of softness run for a while, and things will catch up on their own, a quarter, 2 quarters? What's your sense?
My sense is on the consumption of basic items that should start recovering going forward, because the factors which affected consumption of basic staple items, thankfully they have started reverse. So if you look at both urban and rural areas, job recovery is pretty much ongoing as of now. Income levels have started to go back to pre-COVID levels. So hopefully, basic staples consumption, which unfortunately a lot of households had to cut during those bleak years, they will probably start to reinstate consumption of some of the basic items. So I suspect next 2 quarters, hopefully you see some acceleration in volumes of staples. Coming to discretionary, I suspect this may be a slightly longer term phenomenon. I mean, when I say longer term, more like 3 to 4 quarters. And a lot of it will depend on how inflation behaves, because if prices keep on going upward, unfortunately that does affect affordability of households and the ability to spend on some of the discretionary items. If you look at the prices of some of the items, the amount they have gone up in the last 4 years is pretty worrisome, I would think. I was just looking at something like Dove soap, that is up 13% CAGR actually last 4 years. You look at something like Macaloo, burger of McDonald's. I mean, that's gone from 39 rupees to 52 rupees in 4 years. So clearly prices have gone up a lot, which is effectively affecting affordability of even the higher income households. People who thought they were in a position to buy, let's say, a 2-wheeler or 4-wheeler last year, suddenly they realized that, prices are up like 10%, we cannot afford it anymore. Hopefully, assuming prices don't go up now, inflation is starting to come under some control, and as income levels keep on rising, hopefully this affordability factor starts becoming better over the next year or so.
Oh, I take your point entirely. I mean, pockets are being pinched, right, because of inflation. Whether you talk about the lower strata or even the higher end, definitely inflation is hitting consumption. But I wanted your thoughts on the technology space, because this year some of them have come back in a big way, whether it's HCL Tech, TCS, Tech Mahindra, all up about 8 to 10%. Do you think the worst of the fall that we saw last year is behind us, and has the time come to at least nibble into this pocket now, the large cap tech companies?
It's too early, to be honest with you. Somewhere I think Indian tech companies are performing in line with what was happening in the US. So somewhere the US in the last 1 month or so, some narrative had got built that, since inflation is coming down, the extent of rate increases will not be very high by the US Fed. If you look at the US Fed futures rate, until recently the expectation of the market was it would peak at about 5%. Now in the last 2-3 weeks, it's gone up to actually about 5.5%. So if you look at the most recent data points in the US, inflation still continues to be very, very high. Retail sentiment is still very good. Labor market is still very, very strong. So these may look like, good points as far as the economy is concerned. But my worry is, the US Fed has no option but to keep on tightening, raising rates, and market has finally started to, I guess, realize that, the inflation problem is still not coming under control. So somewhere the market is readjusting to this higher for longer interest rate phenomenon now. And I would assume the US economy has to slow down significantly for inflation to come down. I don't think the earlier belief that you could have, a nice situation of inflation also coming down and the economy continue doing well, I am not very clear how that will exactly play out. So I think the stock prices are definitely not factoring in any sort of a major slowdown in the US, or God forbid even the possibility of a recession. If you look at the multiples of most of the IT names, they are significantly higher than pre-COVID levels. You could argue maybe pre-COVID levels valuation were on the lower side, but across the board IT names have seen a big rating compared to pre-COVID levels. And if our thesis is correct that the US has to have a bigger slowdown if inflation has to come under control, then I think you could possibly see a period of derating for the IT names too.
Okay, Sanjeev, just to stick with that consumer theme that you were talking about, are there any pockets there where there has been, like for example, consumer durables, right? We've seen big price damage across the board in that space. That one should, where the opportunity size is still very large over a number of years, which one should get exposure to now, when things are down and out? Any other, your view on durables per se and other areas in that consumer space?
See, the way to look at it is what's happening in the short term and then in the medium to long term. So if I look at the short term, as I was saying earlier, we do expect some acceleration in volumes of basic or staple items going forward. If you look at the multiples, some of the staple names, they have not really related compared to the pre-COVID time frame. So assuming you continue to see, income growth, job recovery, all the good things in the next 2-3 quarters, I would assume, volume numbers should start coming back for the staple names, which means even though valuation on absolute basis may be high, the fact that they have not related significantly over the pre-COVID to now, in fact, some of them are actually down on a 12-month forward basis. Presumably the multiples remain intact. You make some money on simply, earnings growth. So that's one area which you could look at. The staple space looks interesting as of now, I would say. The discretionary names, I would still be a bit cautious in the short term because I don't know how long the slowdown is going to be. But if you are positioned for the medium to long term, let's say anywhere from 2 to 5, 10 years, investment horizon, I think some of the, consumer durables, as you rightly said, could be interesting because we have seen a big correction in the prices. Valuations are not that bad in the, assuming, let's say, medium-term growth prospects of these companies. So you could look at some of the names like a Crompton, etc. Valuation is not that bad. It's about 35 times on a 12-month forward basis now. There could be possibly some more earning downward, but I think the worst of the bad news is probably seems to be priced in over there.
Okay, let's wrap this up with your conference that is currently underway, the Chasing Growth Conference. What is the investor mood like? What are the themes that you're looking at?
Well, as of now, people, are coming back to India after 2 to 3 years. So the themes haven't really changed much. Ultimately, people want to own, consumption, investment and outsourcing sectors in India. Investors generally have a fairly positive view on India, I would say, on a medium-term basis. So nothing really has changed in that construct. The only thing which people are doing now is probably taking a call between China and India on a more short-term basis. So for the last 3 months, as you would have noticed, China has done phenomenally well compared to India. And a lot of investors probably have taken that call, that maybe in the short term, China is a better market, given the valuation differential between India and China had become extremely large about 3 months back, somewhere about 100% premium for India compared to China. The premium has come down to more like 80% now. I don't know what is the right equilibrium level between China and India's valuations, but over the next few months, assuming Indian market hopefully let's say remains where it is, valuations start looking more reasonable. I would be surprised to start seeing some interest coming back to India because people do like the long-term prospects of India. It's one of the few large growth markets which still left, which can give fairly handsome returns over a long period of time. It's just in the short term, I guess people are simply looking at China more favorably. Plus, the absolute valuation in India is still on the higher side for all the stocks that we would like to own in India. Okay. Yeah, so that's where we are.
All right, we'll leave it at that. Thanks a lot for joining in and taking us through your view